April 2025. The markets hummed with their usual nervous energy. Then, the news hit. Scott Bessent, the president's hawk-eyed economic advisor, had made his move. He ordered the immediate cancellation of all pending loans to China. $78 billion vanished in a keystroke, a shot across the bow, a declaration of financial war. The markets reeled. This wasn't a trade spat. This was different. This was serious. The Chinese yuan stumbled. The Dow Jones plunged. Panic rippled through trading desks from Wall Street to Shanghai. The world held its breath. This was a gamble, and everyone knew it. The ramifications were immediate. Chinese companies, starved of expected funds, scrambled for lifelines. Some foundered. Others turned to Beijing, desperate for a bailout. The ripple effects were felt across the globe. Emerging markets, heavily reliant on Chinese investment, braced for impact. The world watched, captivated and terrified as the opening salvos of a financial war echoed across the globe. The U.S. bond market, the bedrock of global finance, felt the tremors. China, holding almost $1 trillion in U.S. treasuries, was more than just an investor. They were a lifeline that Bessent had just threatened to sever. The logic was brutal, almost reckless. Forced China to back down by squeezing their economy. But the U.S. economy wasn't immune. It was a house of cards, built on debt and propped up by foreign investment, much of it from China. Bessent's gamble assumed China would blink first, that they valued stability over challenging U.S. dominance. It was a huge bet. The stakes, the future of the global financial system. The seeds of this crisis had been sown long ago. Trump, back in the Oval Office, had pushed through his signature tax cuts, a whopping $9 trillion designed to supercharge the American economy. The markets cheered, the Dow soared. But not everyone was celebrating. Economists warned of ballooning deficits. The Congressional Budget Office projected annual deficits to surge by $2.3 trillion. Moody's Analytics painted a bleak picture debt-to-GDP ratio soaring past 140% by 2028. Fitch, the credit rating agency, placed U.S. sovereign debt on negative watch, a clear sign of trouble ahead. 30-year mortgage rates, a key indicator of economic health, shot up to a staggering 8.1%. The housing market, a cornerstone of the American dream, teetered on the brink. Trump, however, remained defiant. He hailed his tax cuts as a victory for the American people. But were they a Pyrrhic victory, a prelude to a greater economic crisis? The warning signs were flashing red. Foreign central banks, sensing instability, started dumping U.S. treasuries. Japan, a longtime U.S. ally, slashed its holdings by $68 billion, hitting a 12-year low. Saudi Arabia, flush with oil money, quietly reduced its exposure by $45 billion. It wasn't just about Bessent's gamble, it was about Trump's reckless policies. The world was losing faith in the U.S. dollar. The almighty dollar, the world's reserve currency for decades, was starting to look shaky. The flight of foreign capital had begun. It was a slow trickle at first, but it was gathering momentum. Each sale of U.S. treasuries pushed up borrowing costs, putting further strain on the already burdened American economy. China wasn't just sitting back and taking punches. They were fighting back, strategically and decisively. While the U.S. was weaponizing the dollar, China was offering an alternative, the digital yuan. Their 10-year digital yuan bonds offered a tempting 5.8% yield, outperforming U.S. treasuries. Global investors, hungry for returns and wary of U.S. volatility, took notice. In the first quarter of 2025 alone, global purchases of Chinese government bonds surged by an astonishing 41%. China was positioning itself as a safe haven, a stark contrast to the increasingly unpredictable United States. The yuan's share of global SWIFT payments had doubled since 2022. The dragon was rising not just as an economic power, but as a financial force to be reckoned with.